Yeah. All right. So we are going to talk about the dog collar portfolio. I will save any of my normal market comments for afterward in the Q&A section. But thank you all for coming. This is, I think, probably a record-setting group. So great to see a full room. Um, so what we're going to do is I'm going to try to, for those of you who've been following us for a long time, and thank you, I'm going to try to tie, let's say, what folks already know about Sun Garden and Yield at a Reasonable Price, which is the dividend factor that I trademarked some time ago. I actually created it with my then college-age son, who I'm happy to say just passed level 2 of the CFA, working on his own in the industry and crushing it, just like our two daughters are in what they do. So we could not be prouder, Dan and me. Uh, but I think the markets are changing. They've been changing for a long time. And yeah, we'll see new administration, et cetera. But this all transcends that. Okay. This is essentially a way to take really total return investing and maybe help a lot of people do what I am doing with my money, which is what all this is based on, what Sun Garden is based on. And what I'm doing with my own money, increasingly, is trying to define a worst case outcome and also knowing what the best case outcome is, knowing that the best case outcome is never really capped. Okay. But you can cap the downside. And there are a lot of funds that do this and stuff like that. But what I figured out as I was putting a lot of this together is, investing still starts with yield at a reasonable price for me. And I will explain specifically what that means. And I'm going to show you some very live examples because literally starting tomorrow, I'm going to be starting to build my portfolio. The subscribers to Sun Garden York portfolio service on Seeking Alpha will start to see those come through. I think in addition to this, I mean, there's some options education here too. All I would tell you about options is that first of all, nobody should be afraid of them unless they don't know what they're doing. But one of the reasons folks like me decided to keep working and not retire is because I think it's a very important area that is often misunderstood by investors. In fact, not an hour ago did I look at a comment on one of my articles and somebody was saying, oh, well, I'm invested in these very high yield stocks and that's much better than investing in those risky put and call options. And I said, we'll have to disagree on our definition of risky because he was talking about a stock that I'd written about that I think has fallen 60% in price a couple of times. And a put option, as we'll see, a put option allows you to define your loss come heck or high water. It can't get any lower than that. And to me, in this environment, and frankly, the more volatile it gets, the more attractive options may be, not in isolation in this case. I do use them in isolation for, I own puts and calls on the S&P 500 or something like that most of the time, but that's a little garnish in the portfolio. I'm talking about taking a plain old stock portfolio with high quality companies in it and wrapping around it an option collar. The reason it's called the dog collar is, first of all, I thought it was cute. And secondly, most of the stocks that we find in yield at a reasonable price investing are, I don't know, shall we say, down on their luck. All right. So with that, let's move ahead in. And these slides are freshly updated, most of them. This is an oldie but a goodie. So let's set the scene here. Okay, I'm a baby boomer. I'm 60 years old, actually closer to 61. I'm reminding myself. But I'm the tail end of the baby boomer generation, and if this had happened to us a while back, when we were younger, and I guess it did because this is the S&P 500 and Vanguard Dividend Growth Index back earlier this century. We've spent half this century for the S&P 500 making almost no return, and that's including dividends, total return. People don't realize that, and I don't know if it's going to happen again. I try to deal in the range of possible outcomes, and then I try to shrink them into my favor. So if you're a boomer, you didn't care if the stock market went for a decade when you were 25 years younger. You probably care now, and so that's kind of the perspective here. And just to think that it can't happen, again in our lifetime. Well, up until a few months ago, we were going on about a 3-year hiatus for the average stock in the top 1,000. Hiatus from what? Hiatus from making money. Because again, we're looking at total return, and there was none of it here. It would take just one quick correction, and this will extend all the way out until now, over 3 years. And I'm going to show you some specific examples, because sometimes it is the stocks that are pushed down the most, that are still profitable companies, that make the best dog collar candidates. So, I'm an investment disruptor. I'll save the thunder, but I'm not as much of a disruptor as the guy I interviewed for the Seeking Alpha podcast today. But you'll find that out probably in a couple of weeks or less when it posts. Disrupting income investing, disrupting total return investing. It's just a reaction to what the markets give us now, and and how to take advantage of it. It's been different since the pandemic. Precisely, I can point to the beginning of 2021 as when investing started getting weird, and it was only starting to get weird because I don't think a lot of people realized that it was changing maybe forever, because you can't put algorithmic trading back in the box. You can't put a wide swath of the population, especially younger people, learning investing at an earlier age. Maybe they're being miseducated like crazy, but that's not the point. Okay, there are different factions in this. Don't even get me started on AI. Okay, and as I say, I should know because my middle name is Allen, so that makes me Robert Allen Isbit. So I'm RAI, right? Okay, no more dad jokes. Dividend yields are lower. Dividend stocks are very quirky compared to the way they used to be. T-bill rates are still high compared to what we are used to. And there's a lot of investor complacency. I will say this about the style of investing that I write about and do for myself and run through for the subscribers of Sun Garden York Portfolio, the service investing group on Seeking Alpha. The type of stuff that we do in the group, it is not something that you should expect to pick up at the last moment when all the blank is hitting the fan. Because I think it takes some repetitions, if you will. So again, setting the stage here. So the S&P is yielding about half of what it was 9 years ago. Okay, it's yielding in the low ones. It was in the 2.2 area, something like that. I think we're about 118 now, something like that. The average stock yields only about 20% less than it did. Now, a lot of this has to do with the fact that stock prices went up. I'm certainly not denying that. However, there are some stocks that were left behind, and the stocks that were left behind, you have two choices. You could ignore them, because they're loser stocks, or you can look at them as an opportunity, but as I like to say, sort of don't go out there without some protection. And that's what we're going to get to in a couple minutes. Yeah, I haven't used this before, but I think it's a lot more relevant now because we're going on a long, long period of time. This is like going back about 8 years now, actually 9 years. And look, the Sun Garden Core model portfolio, which was the predecessor, this is what I ran for my client base. And really throughout the 27 years, I was a fiduciary advisor and a fund manager. This was kind of my beat. Sold that practice 5 years ago, retired, haha, for like 5 minutes. Couldn't stay away. And so I call myself semi-retired because I'm still active writing, publishing, and just basically trying to find ways to be useful and get paid fairly. Those are the only two things I'm after in my career now. So, uh, this thing about high yield stocks. I mean, there's a couple of indexes for these that Global X runs, and these are ETFs, DIV and SDIV. This one I think probably yields, I don't know, 7%. The other one yields double digits. So, you know, and granted, the pandemic had something to do with that, but just philosophically, I want to try to be a little bit more like this purple line, but frankly, because this was not a high equity allocation portfolio, it was more like a bond substitute without using bonds, more like long short equity, if you will. Uh, but I'd certainly like to do even better. But it just goes to show, okay, this is what we don't want. At least this is not what I want, because it can leave you hopelessly behind. Because for all of the high income you brought in, you still didn't do as well as something that kind of puttered along, with a sort of a baby-sized standard deviation. Okay, this is what core looks like, and I'm not touting my track record here. What I may be touting though is low volatility investing, which I've done in many different forms since the 1990s. And the YARP portfolio that we run now is part of that. And the dog collar section of it, which I think may end up being the feature going forward, and maybe the main attraction point for folks that work with us, the dog collar is along those same lines. It just has more upside. And again, this is, I talked about beginning of 2021. Well, this is the actual standard deviation of a 60/40 portfolio. That's what AOR is. And the core model. Okay. Now, I don't know how familiar you folks are with standard deviation and putting it in context. I was happy to run a higher standard deviation pre-pandemic. Ever since the pandemic, it's been dropping and dropping and has settled in here around 3%. A 3% standard deviation is about as volatile, I would say, as a 5-year US Treasury note. Okay. But obviously, the returns have been better than treasuries. But again, I don't want to focus on this. I want to focus on low standard deviation, low volatility, and not limiting your upside by doing it. That's what the dog collar approach is all about. And that's why the options are so important. It is also, I think, a great way to use the trademarked proprietary yield at a reasonable price that developed about a decade ago, and trademark is much more recent. And I've managed money this way for the better part of a decade, but I've always done it in different ways. The idea is this: a stock, and this is just one example. Okay, I can show you some others if you like. In fact, we'll probably do a whole session where we'll just talk about YARP and the YARP factor and how it works. But the bottom line is, look at this. This is a 7-year period in which the stock, doesn't matter what stock. I look at 7 years of dividend history, and then I ask myself a question. Given where it is now, where is that on the spectrum of the lowest yield to the highest yield? Okay, this was the study I did, with my son back when he was interning with us, like almost a decade ago. So if you have something where the range is, let's say, 3% to 6%, and it's down here, and it's a little bit outdated, but it's all about the concept. And it's starting to come down. Well, that usually means, of course, that the price is going up. But the price going up is one thing, and as a technician, since I was a kid, you can see that on the chart. But this is an additional measure of comfort, if you will. Okay, bit of a security blanket, because not all the time, but the vast majority of the time, when you see a stock coming off of a 7-year high or close to it in dividend yield, which means the stock is in the dumps, and starting to move higher, that combination of the yield and the price trend, which is where the technical analysis work comes in, you combine those two together, and what do you get? You get decent yield, and you get it at a reasonable price. Question is, how reasonable will it be? And this is where I went from everything I've been doing so far in the Seeking Alpha program, the investment group that I run. I went from there to saying, wait, I can add another piece to this. So not really changing anything, except we're adding one more piece. What is that other piece? Well, it could be a treacherous market going forward. We haven't had a treacherous market in several years, and even when we did, it didn't last long. We are overdue for, a whopper of a decade. Okay, and even if it doesn't happen, so what? Just make it easier to make money all around. But my thing, I've always prided myself on being sort of like the one investor in the neighborhood who stands a chance to make money when the market is frustrating everybody. That has always been my thing. Even in 2020, early 2020, when the market fell 33%, and that core portfolio was up 2.5 in 5 weeks. It wasn't because I was speculating. It was because I was playing defense. But I was playing it in a way, in part using options, that allowed me to first defend and then exploit what was happening. And so I guess that's a long way to say everything I've done up until this point, adding another leg to it, and the leg that I'm adding is, if a stock is starting to bottom on an intermediate to long-term basis, it doesn't mean it won't just roll over and die again and maybe get worse, because that's what happens in a bad market. They all go down eventually. And that's why I want to have an ironclad protection on the bottom. And as you will see, we don't have to give up really any upside, and you can define your downside at a lot less than maybe you think. Okay, I had to refresh my memory because I actually did run a portfolio similar to what I now call the dog collar for some of my private clients back in the day. I started in 2007 and I ran it until 2010. So you can imagine in the 37% decline in 08. So I've kind of come back to it now because the options market is just so buoyant, and so much easier to use, and so many more stocks are optionable. So it's the liquidity of the options market that kind of brought me back. Okay. So we are trying to replace this stock pick culture, which I think is ultimately toxic because eventually they all go down, at least for some period of time. Replacing that with portfolio construction. Reaching for yield, not my favorite thing. Maybe income envy would be another word for it. I want to define my best and worst case. You can. You actually can. There is more of a total return approach, because if we're so stuck on, I got to get my yield, my dividend payment, you are opening yourself up to an infinite amount of downside risk. That's for other people. I don't tell anybody else what to do. I'm telling you what I do just based on having done this professionally for 30 some odd years. And run it like a business. Part of the business is looking at the business landscape, looking at the market climate, as I like to call it, and figuring out how to enhance your process. Okay. My number one rule is avoid big loss. Then I want to make as much as I can. You'll see an example of that in just a few seconds. It's always more important to avoid big loss than make as much as I can. That's my thing. I want to be flexible and I want to be adaptive. And I think that the dog collar really brings that to the next level. And I want to play offense and defense at the same time. So really, this is all part of what I've been doing. So let's take a look, and I'm not going to go through every one of these, but I can certainly go back to this. Uh, this is far from a complete watch list for what I'm looking at for the breakout this week, of the dog collar sort of angle on the SunGard New York portfolio, which also has ETFs and other options and other stocks in it. This is more a symptom of today's markets. It's great that we have these rocket ship companies that are doing really well, and as long as, fingers crossed, AI delivers like it should and whatever, okay? But to me, I'm not looking at that. If you want to buy that, it's easy to buy. You can buy it through the NASDAQ, you can buy it through the companies, a million ways to do that. I'm saying, what about those of us who want to try to make as much as we can, but we want to cap the losses and know what the cap is in advance without any shenanigans and using private investment pools and things like that. I want to use the liquid markets and be as liquid as I can. So, I mean, look at this. This is 20 companies. 20 companies. This is their annualized return since the beginning of 2022, 3 years and a half a month from when we're recording this, okay? Annualized. That's Estee Lauder right there, okay? That's Walgreens. Now, a lot of these companies have fallen into disrepair, although I will note that Seeking Alpha's profitability grades, which I'm a big fan of, except for these 3 worst offenders at the top and maybe Expeditors, which was such a highly thought of company for so long, they all have profitability grades in the A range, okay? Doesn't get any better than A plus in this system. And, they're decent yielders, okay? Some of these yields may be fake. I don't know if an 8% yield is going to last, okay, or a 7 for Verizon. But my concern is, can we go somewhere to really find value? Well, on the surface, if you start with profitability and you start with, and frankly, yield does not have to be that high. It doesn't even need yield potentially, but it always helps because it's just another cash flow you're getting in addition to what you get from the return part of it. But I mean, these are not fly-by-night companies. Okay, there's a bunch of Dow 30 companies in here. I'm a big fan of the Dow. Then there's Dow Chemical, which ironically was kicked out of the Dow earlier this year or last year. All the way down to Qualcomm, which was a real gem of a company, through a lot of history, and is still, an A plus rated for profitability. So, and then also this, hey, how much they're down from their all-time highs. So I look at this and I say, wow, the history of the stock market is such that when this happens, it is often incredible opportunity. And I would love to take that opportunity. And at first I started writing to subscribers and in general and Seeking Alpha, the main audience, the full audience, that, yeah, you know what, I'm looking at contrarian names here. Maybe 2024 was the year where you could rotate through dividend stocks. Now I'm going to rotate, I should say, I'm going to try to look at some of the real punished names and try to think longer term with them. But I'm not going to sit there and leave myself open to every time earnings come out, there's a chance stock goes down 10, 20, 25%, and maybe it doesn't come back to that level for years. Again, I'm a boomer. I don't have that much time. That's how I see it. I don't want to wait another decade and possibly, get a zilch return. And it's just happened too often. So we are introducing the dog collar portfolio. I specifically, you can only imagine how many dog pictures there are out there. And I didn't even go to, TikTok or Instagram. I just Googled it. Okay, this is the one I chose. First of all, he's really cute. And secondly, okay, there are different ways to do every aspect of what I'm talking about: contrarian stock investing, put options, call options, every part of what I'm about to describe. To me, there's a correct way to do it and there's an incorrect way to do it. So this picture was perfect. Okay. I'm going to hopefully give you certainly what I believe, and hopefully what turns out to be the correct placement of these powerful tools. Okay. So a few slides on this and we'll show some examples and I'll take your questions. The research part of this. Okay. Uh, like I said, historically solid companies currently out of favor. What does that mean? In blue here, I try to give you some sort of bottom lines. Since so much of this is, let's call it fresh conclusions to lots of research that's been going on for a long time. I don't have all of this, let's say, in beautiful presentation form just yet, but the subscribers are soon going to have essentially a dog collar analysis tool that I'm going to create, use it for myself. You'll see a little bit of a hint to it now, and we'll try to figure out ways that we can make it very easy to use. Because technically, I mean, I might end up with a portfolio of, I don't know, 10, 15 stocks, maybe 20 stocks doing this at most. But you can do it with almost anything, almost any stock, any ETF. So again, I'm not in the business of providing personalized advice anymore. I'm not a fiduciary anymore. I did that for decades, and 5 years ago we sold the practice, and so now I'm providing the concepts and the ongoing research and opinions. As the subscribers know, we're very active in the chat room and all that, and on these weekly sessions. So I'm providing the little bit of nudge forward so that everybody can walk down their own path toward what they want with this. And yeah, you can copy all my trades. That's part of the service. But I think for a lot of people, they like to know, okay, this is what Rob's doing, but I'm different from every other person on this call and every other person that would consider this. So yeah, you have to customize it for yourself. So I am looking generally at 20% or more off their highs. Not a hard and fast rule, but that's kind of what floats into my mind. Okay. And then again, we're going to use YARP, yield at a reasonable price. Now, what does that mean? Again, a score above 80 and dropping. So think of it this way. If you look at the last 7 years of dividend, like I showed on that previous slide, last 7 years, the dividend of stock XYZ is a lot closer to its highest yield than its lowest yield. Okay, it's cheap on a yield basis. And I define that as typically it's in the upper 20% of the last 7 years. Okay, so again, simple math. If it's traded between a 6% and a 3% yield, that's a 3% top to bottom. So 80% would be 2.4. So let's say it's selling, it's been between 3 and 6. It's around 5.4, 5.5. Okay, that's about an 80 YARP score. All right, but we can't look at it in isolation, because what happens is in YARP, a lot of stocks go to 99 and the stock just keeps falling and it stays at 99. It's one of the things my late father taught me about with charts. You never know when it's going to stop going up or stop going down. Just because it's in motion, it can stay in motion, as they say. All right, so we're going to look for out of favor, and the YARP is actually as good a tool as I can imagine. And yeah, I'm biased because I invented it, but it's designed for this. It really is, and for intermediate to long-term investing. And speaking of that, want to see the chart pattern. Look, I'm all about the charts ultimately. Okay, the market, I think, tells us a story. We just have to listen. And so I'm looking at charts where I say, okay, I think there's more upside potential than down at a lot, by a lot. But I will also consider what I call 50-50 situations. I almost put jump ball here, but I don't know if anybody would know that basketball analogy. But I guess when you start a jump ball, it's 50-50 who's going to win. Okay, unless you've got Manute Bol on one side and Muggsy Bogues on the other. If you NBA fans get that that joke. Didn't I say no more dad jokes? Yeah, that's what he said. So I look at this case by case, and look, the numbers all have to work. Okay, this is not. This can be made to be absolutely automatically by the book, but I've never really invested that way. I haven't fully automated what I do, most of it, but not all of it. Here's the other thing, and this is where it depends on how much money you're going to invest in something like this, okay? Because in order to buy a put or a call option or sell a put or call option, unless you're doing, naked short selling, which is, when you don't own the shares, okay? You need to have another for something to be covered. Let's say a covered call writing situation. You have to have 100 shares because every options contract represents 100 shares of the stock on the put or the call side. So if you can't buy 100 shares, then you're going to be sort of miscalibrated there, and that can introduce some maybe unwanted things if things go wrong. So again, I mean, you can look at any stock at $100 or less, and that would be a $10,000 investment. Some people will look at $200 stocks. Some people will look at anything. Doesn't matter because their portfolio size and their willingness to do something like this is so high that they don't care. They'll 100 shares of $1,000 stock, it's 100 grand. Okay, fine, drop in the bucket. Okay, I'm I'm somewhere in the middle there. I'll probably will focus my own portfolio on a couple $100 and under. And really, when you think about it, it all kind of works out because if a stock is selling for $500 or $1,000 a share or more, well, there are certainly some stocks that never split. But the other thing is, if a stock was, I don't know, $200 a few years ago and now it's 500, it's probably not out of favor. Okay. So it all kind of fits together, which is what is giving me, I think, a special amount of excitement about being able to do this and share with people. When I did this, over 15 years ago for private clients, it was a very small audience. It was we were a boutique shop. So the options market have to be sufficiently liquid. And I may adjust these a little bit, but in the research I've done so far that I'll show you shortly, 20 to 50 contracts a day or more, that to me is sufficiently liquid. There's also open interest, which is an options term. It has to do with how many contracts are actually out there, traded or owned by anybody, and usually like it to be at least that, if not, a bit higher, 100 or so. But we'll kind of feel our way around that as I build this out. And then I want to establish two lists, just like I've always done. Do I want to own it now? Well, then it can go on the portfolio. Or do I just want to consider it if? The if could be anything. Could be technical, could be fundamental, could be earnings are coming up and I don't want to mess with it right now, that type of thing. And that's what the watch list is for. And I've whittled it down quite a bit. Some best practices for this, and then I'll show you some examples. So what are we doing here? Well, you're buying the stock. You are then buying protective put options at or below the current price. So in other words, if the stock's here, the put option is here, and that defines your worst case for a period of time until the option expires. Out of the money, actually, it should be at the bottom here. I thought it was, but I've got a little footnote here on OTM is out of the money. So if the stock is at $50 and you strike a put option at $45, you are struck 10% out of the money. And of course, there's a cost to doing that too. And then I sell call options above the current price. Now, I probably should put another asterisk in here, but I haven't even shown you the first one, so I'll one at a time. But the thing about this is if the puts are cheap enough, selling the call options is capping your upside. Now, I'm going to say this right now, and I'll remind people if it comes up in the questions, because people say, well, if you sell covered call, there's so many funds that do this now. It's so popular, okay? Too popular, I think. And this is our custom version of that part of it, okay? We pick the stocks, we pick the strike prices, you know, et cetera. It's all up to us. And I am quickly on the way to systematizing this so that I don't think the covered call ETF thing is necessarily going to be as attractive when you realize how much of this you can do on your own. And after all, we're all DIY, do-it-yourself investors. So, you know, covered call writing sometimes gets a bad name because people say, oh, you're going to cap your upside. And my response, I've said this to a million people in the comment section on Seeking Alpha after my articles. Is that really the case? Yeah, if a stock's at 50 and your call is struck at 60 and it goes to 60, well, that means that the more it goes above 60, the greater chance that you could be forced to sell the stock at 60. Is there no law against buying more shares? Is there no law against buying, I don't know, cheap, out of the money call options so that if it goes to 61 or 62, okay, I don't mind getting called away. But if it goes to 65 or 70, heck yeah, I want to continue. And again, you can define your risk. And again, for those of you for you know who maybe are not as option savvy, we'll fill all this in. Maybe not all today, but I can see this being the focus of these Monday sessions. You know, at least a bit of every one. Okay, I'm looking for 3-to-1 best case, worst case. I'll show you what that means in a minute. 3-to-1 upside, downside per month. Choose the strike prices in sync with the chart pattern when possible. Doesn't mean we always have to, because you might not even believe in charting like I do. I'm devout, but that also, I mean, you can do this with anything. You literally can. It's just a matter of, you know, what type of risk you want to take. To me, a good encouraging chart pattern puts the odds even more in your favor, and you bracket that option pair around the stock to create the collar. That's what they call a collar, this pair. Okay, and then game plan in advance. Just like I said, if the stock goes way down, it's below the put strike, but the put strike is your minimum. You can't do worse than that, okay, plus whatever cost of the options. If it goes up through the call strike, I just went through that, and you know, what if it goes nowhere? Well, if it goes nowhere, you know, it might cost you a little bit if the options net cost you a little bit. But again, it's case by case. And by the way, that's why I would like this to be as small a cost as possible. Okay, so let's look at the portfolio. And I just want to make sure here. Good. Yeah. Okay. So this in my chart system and you know, and your questions is what we have left today. Okay, so I'm going to just explain what this is, and then I'm going to go to the questions. If you have questions, put them in the chat now, or I am very happy to just have you open your microphones and talk to me. Okay, so I haven't finished the research, and let's face it, you know, who knows if the market will open tomorrow. I mean, it's kind of a weird time in America with transition and all that stuff, and you know, who knows what the next couple of weeks will bring, good or bad, for stocks. Okay, but frankly, one reason that I am going in, I would say, with more confidence to the rest of this year and beyond is because of what I'm going to show you here. Okay, this is a short list that I've gotten down to through a bunch of screens, and again, those of you who are in the service, you'll recognize, oh, we still own some of these. You know, I've gone from a lot of stocks down to like 6. Well, most of the 6 I think are in here. And then one of the reasons I held them is because I knew this was coming and I didn't want to sell them and rebuy them if I was going to consider them for a collar. So let's take CVX as an example, just because it's the first one up here. Okay, and you can see these are all priced under $200, so that gives you some idea. All right, what's happening here? Well, step one, I would buy CVX for, and I would buy, let's keep it simple. 100 shares would cost me it would cost me about $16,000. Okay. Now, the first thing some people would say is, "Wow, that's a lot of money to put in a stock from you, Rob. I don't know. I've only got a few hundred thousand. It's over 5%, and it's a lot in one stock." Okay, keep this in mind. Normally, when we buy a stock at 161, what's our downside? Zero. I mean, you could go to zero. That's what I mean. And downside is 161.47. Unrealistic, okay, in a case like this. But is the downside, half of that, 3/4 of that? Not out of the question. However, if you own put options struck at 160, guess what? 160, if the stock literally goes to zero, okay, assuming the options markets are still functioning and they're liquid and I think in a lot of ways more secure than other types of investments, been around for a long time. The 160, think of it this way, okay? And I'll tell a quick story, because I always like to honor my late father who taught me a lot of stuff about investing. He was drafted around the time of the Korean War. I think the war was pretty much over, but he was in New York City and they were going and giving him, I guess everybody was getting called, okay? Your number was coming up for the draft. And, this one's like, oh, you're going to whatever, middle of Nebraska, nothing against Nebraska. You're going to Alabama, you're going to, upstate New York where you're going to, freeze your patootie off, okay? Then it comes up, Isbits, California. He's like, here I am, here I am, here I am. And he tells a story about running to the front of the room, and everybody's like, this guy got California. So anyway, that's a quick thing about my dad. But it reminds me of, that's how I feel if I own CVX as an example. I bought it at 161.47, and the stock goes to 130 next week. Here I am. I still have the right to sell this for 160 because that's what a put option is. As long as it's 100 shares and 100 shares. If I own 500 shares of this and one options contract, the other 400 are, floating in the wind, available to be lost on, okay? But that's it. So, and again, expiration date, everyone's going to be different. And I look at multiple ones of these, and I can show you some of my sources because I found a really, really good source that I've used for a long time, but I'm really starting to power use it now. Bar chart is the site. So expiration date, let's say 5 months away. In this case, these are, live examples as of Friday. Okay, and what this is saying is, all right, CVX, I buy it for 161. My downside's 160 and my upside's 185. This is not bad, right? The question is, okay, how much is it going to cost us, okay, for that? All right, how much is going to be sort of out of pocket? Okay, now again, in this case, all right, I'm looking at a bid here and an offer. I'm sorry. Let me see here. Yeah, bid and offer here. Okay, and I'll clean all these numbers. This is a sort of a sample. Okay, based on recent numbers, but this is what I'm looking for. Okay, the stuff in yellow are the keys here. All right, 185 to 60, and what I'm looking to do is, okay, it's going to give me how much upside I have and how much downside I have. And I'm going to try to finagle these numbers so that my cost is as low as possible. And I will end up with a lot more upside than downside. Okay, so there's 3 pieces here. There's the call option. I should say, let me start. You buy the stock, you buy the put option, you say, this is my low. You sell the call option, and this is my high for the next 5 months. Remember I said, there's a few different things that can happen. If the stock goes below 160, I can sell at 160 anytime. Also gives me the luxury if the stock goes to 130, because how many times have we seen this happen with these types of stocks? Let's say CVX goes from 161 to 130, and it does it in next 2 weeks. Well, I can hang out knowing I can't do any worse than this. I can just, and I think the options market actually does this automatically for you now. If the stock's below 150, it's going to exercise the put for you, is what we call it. So if this has gone down to 130, and I mean, who's to say that by June, it's another earnings period passes, and maybe the stock gets back up above 160. Maybe it goes all the way to 185. So this also allows us to wait it out. One reason I love T-bills the last couple of years, as I've mentioned many times to our subscribers, I like T-bills because it gives me a chance to wait and see what happens. This does too, as opposed to, gee, I'm down 20%, the stock's at 130. What do I sell? Do I buy more? I don't want to have to deal with that. These markets don't operate the way they used to. So I can't expect them to be as friendly to me as before. So I want to basically dictate my rules of engagement. Go Muggsy Bogues, Spike Webb, that type of thing. Old NBA fans chatting it up. Okay, do you ever roll your covered calls? Yeah, that's part of what I said in one of the slides. The thing about the dog collar is it's flexible. It's flexible, okay? You could make changes at any time, okay? In fact, one of the things, let's say again, I'll just stick with the one example because hopefully we're familiar with it by now, but if CVX drops to 130, all right, the put options are going to go up in price because it's going to kind of simulate, the closer we get to this day, it's going to simulate, oh, these put options, well, if the stock's at 130 and we land on this date, guess what this put option is going to be worth? $30 a share, okay? Because I have that ticket, okay? Like the late, great Carl Isbitz, my dad, getting drafted in the military, $30, because I can sell this with my little ticket here, my put option for 160 and the stock's at 130, therefore it's worth 30 at expiration. In between, it's all, a bunch of Greek math, which I won't share with you. Now, the other thing that happens if it goes down is the call options, whatever you brought in, and in some of these cases you can bring a lot in, okay, this 450 would probably go, down to like 10 or 20 cents. The other option you have, pardon the pun, is to close out the call options, take that off the table, and you can just own the stock outright. And if it bounces back, you don't have a higher end of this. Again, a detail for later. So as far as rolling the calls, that refers to, okay, we're getting close to this. And again, it's always situationally specific. Frankly, that's why I think it actually fits really well into the SunGard and YARP portfolio service on Seeking Alpha, because that's the only place that what I'm doing and what I'm thinking regarding all this is displayed. I might do a little bit of it, examples here and there in Seeking Alpha, mainstream premium articles, but just a little bit. So, as you get closer, I'll give you an example of when you would roll it, okay? So let's say that it's early June and the stock is sitting at $170, okay? Well, it's a long shot to get to 185. It's also a long shot to get to 160. So the options are going to be down in price. So, if I'm 170 on the stock, I'm up in price. I've been getting my dividends, which is helpful. Okay. And then I will, but my profit on the stock is perhaps reduced a little bit by the net cost of the options. At that point, when the options aren't worth very much, unless I really believe something's going to happen, maybe earnings are coming up, something like that, I will it would be very easy to close out the options worth 0 and start over again. There's all kinds of ways to do this by adding on pieces. And frankly, the best way, I think, is going to be every time such a situation comes up, even if it's something I don't necessarily believe in my heart of hearts is the best thing to do, I may do something to say, here, I did this like in a trading portfolio or something, so I could show you a real live example and track it. I like to do that. I'm an educator. Okay. Let's see, can always monitor and roll the covered calls. Exactly right. Thank you, Don. Let's see, thought Intel stopped paying a dividend. That is correct. If you look at that, the other slide that I showed, Intel has stopped paying a dividend, but a dividend is not required here. Just so you know, I'm looking very closely, okay? We own 3 different yield max ETFs that do a lot of the options work. They don't own the stock directly. And I'm looking at this and saying, you know, the one thing that the yield max doesn't do, and I had this conversation directly with the portfolio manager a few months ago. I said, well, what about if the stock gets crushed? Well, we're going to get about 80% of the downside, and we get about 80% of the upside, but you'll transition a lot of your capital gain into income. All sounds good, except for the 80% of the downside part. And I know from doing this in the past, you know, for a long time, that sometimes the best way to take a position in, let's say, the Mag 7s and the Intels that don't pay, you know, dividends or pay very little, is to do it exactly this way. Because if everybody starts, you know, hating on big tech, all right, new administration, whatever the reason is, okay, China, okay, you know, the macro almost, it doesn't really matter when you're set up like this to me. You have a lot more wiggle room, a lot more room for error. And that's what I love about it. So when the you know, if you get a situation where you have stocks that are notoriously volatile, okay, the Apples and the Microsofts and the Nvidias and all that, a lot of times you can get really good pricing on these things. And you know, so I think that is, and there are a lot of covered call ETFs out there on single stocks. I don't know anybody that's collaring. I know one ETF that collars, but again, in all these cases, you're going from being a do-it-yourself investor to choosing somebody else's product. I love a lot of the products, but this is going a step beyond that, and you know, that's why I'm excited to bring it back after literally about 16 years. Okay, because market conditions just didn't favor it like they do now. All right, let's see. Another question. How many stocks do you expect to have in dog collar at one time? So I would say 10 to 15 is my target level. Because, you know, I mean, look, the transactions, a lot of it depends on how far out I'm going. Okay, so I want to go out at least 3 months. Ideally, I'd like to go out 6 months with a lot of these. You know, I could talk next time about the dynamics involved in that, what the trade-offs are. But again, this is a research service. Okay, yes, this can be do what Rob does. I'm flattered and happy it's part of the service, but my goal here is to try to have a portfolio and a watch list. And the watch list, frankly, could contain any number of stocks. I have it here, but when I started whittling down to getting somewhere near maybe 20, 25 stocks to choose, maybe the first 10, I think I started with 180 stocks, something like that. You can do this on almost anything. And, you know, and again, I skipped over it in the slide, but you know, if you say, hey, you know, I'd love to be able to do this, but you know, a lot of those big tech stocks are too expensive. Well, there's probably an ETF that has sufficient options liquidity that maybe you can, or you can say, all right, if I'm going to buy whatever a SPY at $600 a share, well, if I'm doing it on SPY, that's taking the place of 5, maybe even 10 positions in my portfolio. So, you know, the dollars can be rationalized, if you know what I mean. All right, let's see. Oil is overbought at the moment. I wait on CVX. Yeah, we're not going to talk too much about the figures now. By the way, right, you can wait on CVX. Of course, the other thing is one reason to do this is that you can just kind of let it play out, knowing what your worst case is and what your best case is until it gets there, in which case you can continue up as much as you like if you, like I said before, stock goes above 185, okay, you can buy more shares. You can buy a, you know, call option with a little bit of money up here, etc. Okay. All right, let's see. Oh, good. I'm glad somebody was going to ask this question, but I got a couple more before it. Okay, let's see. Okay, thank you, Don, the Air Force story. Okay, let's see. Do you account for the 2 dividends? But yes, I did mention that before. Dividend payments are part of this. There's a little bit of adjustment, I think, in some of the options pricing for that. That's like 201, 301 level, and I'm trying to keep this to 101 today. Okay, let's see. But again, it's extra cash flow. I mean, one of the things I'll do, because you know I am pretty analytical, is I will try to measure with these things how much you know, if this can be as simple as taking the dividend income and saying, hey, I can rationalize this by saying I'm going to get 2 dividends, and the dividend income is going to effectively pay for the options or pay for the puts and make it so I don't have to buy calls. There's all kinds of ways you can do with it. You know, it depends on volatility, depends on what the stocks are doing, and that's why, you know, you can automate this, and that's what a lot of these ETFs do. But you know, why automate it if, you know, you're focusing on 10 or 15 stocks, and you don't need to be that diversified when every case you define your downside. So to me, I like where this is going. Okay, why? This is the question I've been waiting for. Why is a put option better than a stop to control downside risk? Very simple answer to that. Let's say that tomorrow opens and oil stocks just get crushed. Okay. Somebody figures out that oil price is going to go, or contango, and it's going to go, the oil price is going to go negative again. And CVX goes from 160 to 100 before you can bat an eye. Okay. I was there for the 87 crash, so, you know, never say never. All right. This goes to 100. You had to stop at 160. You're out at 160. No, you're not. You're not at 160. You're selling at 100, or you're not selling at all. Because if you have a stop limit order at 160, nothing's going to happen because it's nowhere near 160. And all you did was go from 4 o'clock on Friday to, in this case, Tuesday, 9:30 a.m. It's like earnings. You can't do anything about it unless you're like trading in the aftermarket. And even then, it's going to adjust right away. So if this goes to 100 and you have a stop order, okay, if it's a stop limit order, nothing will happen because it's not at 160. The worst thing that could happen in this case is that it's a regular plain old stop order, and this thing closes at 161 and opens at 100. You just sold the stock at $100 because as soon as the market opens, it's going to go with the market price. This is something that, and maybe it's because a zillion years ago I took the licensing exams, okay, but this is something that so many people do not understand about stop orders. When I was an advisor, I would have this conversation with people. I'm not an advisor anymore. Everybody's on their own, you know, here to teach. But wow, I mean, when people sort of get the other side of that, it is tough. That's why I love put options, because this is mandated, okay, by the regulated options exchange. You're holding that ticket like my dad. 160 is what you get. And like I said, the stock could bottom out for a while and you just say, okay, well, I can't do any worse than 160. Might as well wait around. All right. So hopefully we're clear on that. Do you care when you buy? Yes, I am very sensitive to the price. Um, and if the price is, I mean, look, I'm looking for a good trend in the chart. Uh, it doesn't have to be perfect. Okay. Matter of fact, since you asked, and again, none of these are trade examples because I have not done it yet. Starting tomorrow, I'll have at least one trade out tomorrow, even if it's just almost like an example. So here's a very good example. I just wrote about this one in Seeking Alpha. Okay. Verizon. Is Verizon my favorite stock? No. And like a lot of stocks, quick technical comment, I see a lot of potentially save themselves daily charts, but all the weeklies look awful. Translation, and I'll probably put this in the weekly note to the subscribers tomorrow. It wouldn't surprise me if we had a pop almost like the election, and and another rollover. That's what when I see potentially bottoming, short-term bottoming in dailies and weeklies rolling over and going negative, usually. But let's put all that aside, okay? Verizon here is at least showing signs that, again, like I don't make the technicals up. Okay, why did it bounce here? Why? Because there's so many people in modern markets that are drawing lines like I have for 44 years. And I like to say, welcome to the club. So I don't know, maybe it doesn't have tremendous upside, but if I'm thinking longer term about Verizon, I'm saying, if I'm okay with the business, I think that eventually these things all come home to roost, or maybe I'll strike a put option at $37, and the stock will drop to 25, and I'll sell it just a little below where I bought it, and I'll start the process all over again at a much lower level. Nothing wrong with that either, right? So, I there aren't too many ways to lose. I can't think of a way to lose big in this unless you miscalibrate something. Okay, let's see. Yeah, before, after earnings. I mean, this will make me more bold in, let's say, approaching things before earnings, but not that much more bold. I'm happy to give, it off Verizon. I think announce a little bit later this week. But this is more like, hey, that's interesting. I think I'll watch it. Okay, I think it's really what I said in the article. All right, let's see. How do dividends fit in your calcs? I think I just answered that. Higher dividends than others. I mean, I want all the dividend I could get, but to me, I would put it this way. I don't want to own Verizon at a 7% yield if that yield is at all suspect. Okay, I could literally fill this portfolio with companies with high but risky yields. And guess what? If they all cratered in price, I'm just going to get my put strike level. So I can take the shot at getting that yield. I might argue that it might be a better way to invest in those. But again, option pricing is the other hurdle here. Okay, if the options are extraordinarily expensive, then you have to move on. So sometimes I may find a stock that's great on this basis, but I say, you know what, I'm going to buy that one outright. It's not like I'm giving up buying stocks outright. It's just that there's so few that I'd want to own outright that that'll probably be something that will come back to the Sun Garden Yacht portfolio at a later date. Okay, what do you see as minimum account size? Well, like I said before, it's really, I mean, technically, if you could find a bunch of stocks, selling at I don't know, $30 a share that you could do this with. I can't think too many offhand, but if you could, you do 100 shares, $3,000. You could do a kind of a mini version of this. And again, I wouldn't want to tell somebody what to do because that would be getting too close to personalized advice. All I would say is this. I can own 10 stocks, probably even fewer, in this a lot more comfortably than I can own 10 or 15 stocks outright because, again, I'm defining my worst case, and that's what I'm about. first thing I want to do, avoid big loss. Here, I don't have to, say, oh, I sold that stock, like here, if I own, if I bought Verizon, I don't know, here, okay, and I wrote it down here and say, you know what, earnings come out, it does this, I get a little freaked out because I want to avoid big loss. And the next thing I know, I look back a few months later, boy, Rob, you really missed on Verizon. Don't have to worry about that anymore, right? Not until the call strike and whether or not I roll it over. So this is infinitely, really, like I said, I haven't changed my process. I think I'm just making it even more, if you will, contemporary for the advancement of the options market, the destruction of many profitable blue chip companies and their stock prices, and the fact that dividend yields are not very high. I don't want to reach for yield. There aren't too many 7% yielders out here, and they all have warts on them, as they say. So anyway, minimum size. I mean, the best way for me to answer that will be maybe to come out with something that says, what a portfolio might look like, not a recommended list, but if you wanted to do this portfolio with just stocks under, I don't know, $50 a share or something, you could do it, okay? But, think of all the different aspects of this. I can tell already I'm going to be writing an ebook on this, so all that will be in there. Okay, let's see. Someone just mentioned dividends. Okay, another question. Can you explain the call in the two-leg chain, sell to open versus sell to close? Oh, that was the call and the put is what you had on there. Let me see. Go back to that. There. I did this is the strike price of the call, strike price of the put. This is what you'd receive for the call and pay for the put. Again, I have to roll back through this here because, frankly, if I had chosen, let's say, a more realistic example, actually, it might have been the Verizon, because I don't want to spend that much money on the options. If anything, I like to be able to do the collar costless, where, again, let's follow with Verizon, okay? 47.37, stocks at 39 is not bad. Okay, it's a lot of more upside than downside. But I might also say, I'll look out there. If there's a 45 strike, I'm cutting my return. But look, would I be upset if I made $45, $47 on a $39 stock in the next 5 months? No. That's why I said it's kind of a per month calculation to me. So I would look at something like this and say, wait a minute, if I'm willing to cap myself at 45, or maybe my downside will extend to 35 instead of 37, I might be able to even these two up, and the put and the call cost, I pay as much for the put as I receive in the call. Zero cost collar is what that is called. There are markets where that is easier to do, usually more volatile markets. It was a lot easier to do in 2007 when I did this the first time around than it is today. There seems to be a bias where put options are just always more expensive than calls, sort of pound for pound. So we'll see. That's why I love the investing group format, because it is a great way for me to lead the research and then have everybody else kind of join me in doing their own thing. But I'm hoping that, there are some other people that'd be like, help me improve this process, it's like having an investment committee. Okay, let's see. Do you recommend sizing a TBF position to hedge bonds or preferred stocks? Full disclosure, I own TBF in the SunGard New York portfolio. It was bought fairly recently. We've all been waiting to see what the immediate reaction would be to the election and what happens first week, first month, etc. So we're getting closer. Sizing the TBF position, I cannot recommend anything. I can tell you what I do. I believe it is a 5% position right now. My ETF positions tend to be either fives or tens, occasionally 15 if it's something like a T-bill ETF. But I think we're 5% now. But again, when I buy an ETF, I could hold it for 2 weeks, I could hold it for 2 years or somewhere in between. But the other possibility, and look, here's another example. Okay, if I think that rates are going to fall through the floor at the long end, you know what I'm going to do? I'm going to look at TLT. And so what if it's not a stock? I can dog collar that just as easily. I'll go anywhere where I can make, a strong reward risk trade-off, knowing what my worst case is. That's what this is all about. Okay, let's see. Are you going to include Canadian stocks in the strategy? Watch list cut. I keep nudging Seeking Alpha because I've said to them, I'm willing to cover Canadian ETFs, certainly Canadian stocks. Look, we are subscriber driven. If you're a subscriber and you're paying, what was $975 now $1,500 a year to join the subscriber group, as far as I'm concerned, once you get past the first month and you have stayed, because I think it's a 30-day trial, once you're past the first month, just try me, try me. I can't get personalized advice, but we've got a couple of Canadian subscribers, and I went to Seeking Alpha and I said, hey, I'd love to be able to cover some of the ETFs, but you don't have them on the coverage list right now. I gave them a list of over 150 Canadian, traded in Toronto ETFs that are a lot like the ones here. If they say, yes, you can cover them all, I'm going to hire a writer. I'm going to hire a young writer, give somebody a job, and they can help me cover the Canadian ETFs. So you can imagine if, somebody has a particular, hey, can you look at this or that, whatever, I can always come back and say, here, if I were collaring, this is what I would do. This was the dog collar I would put around it. And I would say, am I high confidence, medium confidence, or low confidence? What's the stock like? You can see this is going to be a research tool that hopefully, with a little bit of assistance from someone other than me, we can turn this into something that is more than just a portfolio of what does Rob own right now. Okay, let's see. How many days, hours a week we say it takes to maintain? Great question, because I'd be lying, and I don't lie. So I'd be lying if I said that I was did not have some motivation here to not let the markets eat me up with for these periods of time where they go nowhere. My biggest issue in owning stocks, and it always has been being a risk-averse investor, is when I own a stock, my biggest concern, as subscribers know, is as you get close to earnings, okay, I start to, get the sweats, all right? Because I do not want one of those things to hit me. Happened with Target last quarter. I wrote about it because I always write about, things that go wrong as well as right. If I had had a dog collar on Target, you know what? I would have been able to put the position out there. When do I have to look at it again to answer your question? Technically, I don't have to look at it until expiration date if I really want to be lazy, but of course I'm all over this stuff every day. So, I will focus in on the ones that need to be focused in on, and I'll try to help subscribers say, hey, I'm paying closer attention to this one, put a yellow flag on it or something. Yeah, might need to do something with this. Here's what I'm thinking about doing. That's how it works with the subscribers. So we use the chat for a lot, which is great. So to me, I mean, look, if you set it up initially and you have 15 stocks, it's going to take you that long to do, 15, you find the stocks. Obviously you can use my research, but find 15 stocks, plot out the options. That can take a while, especially if you're not familiar, which is why I'm going to judge, for myself and try to give people, like I said, a regular list and a watch list. Every day the prices change. Okay, that's the thing. If stocks are volatile, that's why you kind of have to be in the moment when you're ready to do it. Figure out what your parameters are. Oh, gee, the stock moved way up. Okay, do I still want to do this? Do I still want the 185s, 160 if the stock is at 170 tomorrow? Now I've got more downside. I mean, these are going to be the follow-up sessions because I would love the feedback from everybody in the group or otherwise, but I think I have something here. I really do. I mean, I always knew I had something with YARP. I think I really have something to use YARP as that first step in the process to go and do this. But the more people that tell me, yeah, I'll focus more on my research on this because I'll tell you what I won't be doing as much of. The turnover in the portfolio just won't be anywhere near as high. So you literally, if you wanted to, given that these things are 3 to 6, 7, 8 months out, you literally could say, okay, every Monday at noon, I'm going to look at this for an hour and I'm going to review it. And I'm going to try to put my own process in for what is up for review. Okay. Like how far does something have to go before I'll flag it? And I will do that. And if I find a good system to do that, I'll tell everybody what it is. Okay, let's see. Yeah, so the number of stocks that you own, David, is that it's think of it this way: it's upfront work. It's upfront work, and then each of them has to be managed. In a perfect world, I will ladder, if you will, the expiration dates. I'd love to go out further with a lot of them, but sometimes the numbers don't work. And again, there's all kinds of nuances. I'll have more feedback on that, I think, after I've completed it. Don't worry, there'll be plenty written and spoken about this. Okay, let's see. What Schwab platform are you executing the trade? Standard platform or I think I'm embarrassed to admit this, but I literally, in all the years I've been on Schwab and then the TD Thinkorswim, which is this great trading platform, I still haven't learned much about the thing. I still do it the old-fashioned way and the regular one because I've become so quick at it that it's whatever. I can do it from my phone. I'm not afraid to say I've traded on Schwab, not on TOS, but on the main Schwab from the Serengeti Desert. I have certainly traded from the beach. I have traded from a cruise ship. And other places you can only imagine. So, to me, the Thinkorswim would be better, although I don't really know it yet. You don't need a slick options trading platform, but I will say one of the things I'm going to look at Thinkorswim for is whether or not they can save some time in doing the analysis. Okay, this didn't take me terribly long, but I love to just come in every day and say, update the prices, show me, I told it what I'm looking for, this type of upside, this type of downside, stock price in this range. Again, this will be 301 stuff in another session. Hope you all come back for me. Okay, let's see. Better option premium before earning on the call side. You'll need to sell the call and buy okay. I think somebody talked about exercise. Yeah, I'm not quite sure of the question. Thought about owning preferred stock. I hate preferred stocks. Doesn't mean that they're not good. I just have never felt the need to own preferred stocks or convertibles or muni bonds. I've heard it says mini bonds, ETD. I'm not sure what that means. Oh, maybe ETD is a muni bond ticker symbol. I'm not sure. Never been a big fan, but again, it's also a tax question unless they're taxable munis. Versus high dividend stocks, the good, the bad, and the ugly. Yeah, I mean, look, I know I'm going to have this debate with people because I'm already having it in the comment section of my articles and everywhere else I talk about this stuff. Go back to the checklist, if you will. What's the checklist here? I want to know what my worst case is. And again, I'll just use the same old example and wearing out CVX here. Okay. Well, if I can't do, again, there's a cost to the options, okay, but that can be finagled, okay, to reduce the cost, okay. As a matter of fact, it shows you right here. Okay, I should have colored this column, but okay, I don't want a 4% cost of the stock in price. If you know, it's like 1% a month, that's a lot. These will be much smaller when I put the finishing touches on it. Okay. But in this example, okay, if I know that my cost is, you know, whatever percent, I have a worst case, I have a best case, but it's not really the best case because I can always buy more. I know exactly when this is going to last for, and hopefully, if the best case scenario, stock goes 184 and a half, both options expire worthless, and I'm holding a $161 purchase at 184 and change. And guess what I go and do probably before this? I go and I redo the collar. But now I'm doing the collar, and my worst case is, I don't know, maybe it's 180. Well, I not only have I locked in this, I've locked in a minimum profit on this thing. Okay. If you get a stock in intermediate to long-term bottom, let's say Verizon, you know, doesn't see that price again for a couple of years, up and up and up it goes. What was my risk? Whatever the cost of the options and the strike price. But like I said, I'm going to try to bring that down to, I don't know, maybe 1% for every month to expiration. Okay. All right. Somebody recommends Interactive Brokers. Yep. I've heard nothing but good things about them. All right. Great session. Thank you. Somebody says, and I think that's it for the chat. So that brings us to either the close. We're an hour and a half in, but you know me, if you have more questions, yeah, ask me anything, and we'll pick this up next time. And we'll pull up the charts just in case anybody needs. All right. Any questions? Okay. If you're not a subscriber, you know where to find us, hopefully on Seeking Alpha. If not, just info@sungardeninvestment.com, and we tell you about it. Thank you all for attending. And I'm looking forward to talking to you more about the dog collar down the road. Take care.